Radio News Hour, Joe and Jason on this Thursday, the day after. Wow, what a crazy day. We've got all-time record highs on Wall Street. Gold and silver, a tear-your-face-off rally as Jay Powell shocks the world and was nothing but dovish. We'll bring it all to you. But remember, our toll-free number, 800-951-0592. The website at allamericangold.com. Make sure you get out there to YouTube. Get out there to Rumble. Share this, like it, thumbs it up. You know, do all that great stuff. Jason, I think everybody's kind of in shock today. Yesterday we were kind of saying, okay, was he going to, be hawkish? Is he going to be dovish? And I said, well, I think he's going to be a little bit of both. That was not the case. All the things that we talked about, remember when I was telling you, this is be thankful that gold and silver are down. Right? Be thankful. And I started rattling off. Here's all the things that are going to come in 2024 that are going to drive gold to all-time record highs. Don't be shocked. I'll make this call right now. Don't be shocked to see silver challenge its all-time record high. And silver, it's at 24, just below 24.25. Silver's up $1.50 in less than 24 hours. But would still have to double and add a few bucks to get to an all-time record high. Jason, that is very possible if things don't go according to plan, because Jay Powell and his cronies, I'll say this, obviously something inside of their data have them talking about, you know what, yeah, the rate hiking cycle is over. We got to talk about rate hikes. He talked about quantitative tightening and ending quantitative tightening. He talked about the reverse repos. He talked about how they don't expect growth to be much more than 1% next year. And I think this, in a weird way, right? Wall Street loves it. Gold loves it. Silver loves it. Oil, everything, everybody loves it. The one thing that probably is now a guarantee, we won't get to 2% inflation. I think that's kind of what they decided they were going to that was the sacrificial lamb.
Yeah, I'll go further. I think they know that we're going to get massive uptick in inflation in the year and 2 years to come. And this $8.5 trillion of debt that's rolling over, I think they want to lower the rates a little bit to soften the blow of their interest that they have to pay the government and the Fed on their assets. And then I think they know that maybe at the end of 2024, they're going to be raising rates again and raising them much higher than 5.5. So Joe, it's all working.
A boomerang.
Oh, yeah. You look at the inflation in the 1970s, we've been following that trend almost exactly. If you look at a line chart, the highest part of the inflation is still yet to come from the late 70s into early 80s, and it dwarfs the inflation that happened just before it. So we're heading for that, and I think if they can trade off some of their rolling over debt to something that's more like 3%, if they lower the rates 2%, then when the inflation becomes too big of a bear, which is, I think they know here comes the inflation. It's making all the rich. It's going to make all the rich friends happy. All their assets are going to go up. Property, the stock market, all these things are going to go up for a while. I mean, the things that are going to happen next year it's going to be incredible. And I think I think the government spending is not going to stop. It's going to accelerate, and it's going to be higher rate debt. So they're going to give them a reprieve on the borrowing, and then here comes the inflation, Joe. It's going to be crazy what happens next year, Joe.
It's interesting that you say that, because obviously one thing for certain, right? The interest on the debt will come down a little bit now, right? Because we're not going to pay 5+% on that, so that'll help a little. The losses that the Fed is taking because of quantitative tightening, The Fed has lost like $200 billion. That'll slow a little bit. The unrealized losses on these banks will come down because the higher the rates go, the bigger the unrealized losses get. And so there's some benefit there. And I think a lot of this has more to do with the issues in banking that they don't want to resurface. But it was very interesting to hear, Jay Powell, the base scenario does not call for any rate hikes. Matter of fact, the only thing he said about rate hikes, well, if something dramatic happens, yeah, we could always raise rates again, but yeah, that's not what we're looking at, right? That's not what I just said, though.
Isn't that what I just said, though? Something dramatic will happen. It'll be in the back half for the Fed. August or September of next year. That's an eternity. So there's your dramatic thing where they raise the rates. It'll be like November next year or something, Joe. You watch, it'll happen.
We're going to see how it all plays out, but when we get back, we're going to talk dot plots. What are all the Fed governors saying about where interest rates will be? How many rate cuts do these geniuses up at the central bank think that we're going to get in 2024? And then we'll go, we didn't get jobless claims. By the way, jobless claims came out today. Jobless claims were spectacular. Don't cut rates at all, right? Jobless claims were almost like raise rates. It's crazy. It's a crazy market. Gold's crazy. Silver's crazy. Stocks are crazy. Everything's crazy. We'll be back. We're back here. Patriot Radio News Hour. Joe and Jason here on this Thursday. A quick look in at the markets. The Dow up 75 points, 37,164. The S&P up 9, 47,16. The NASDAQ up 10, 14,740. Gold up 60, 23, or 23, not yet 23. 2,043. Silver up $1.60. $24.23. You got to remember, so when the Fed comes out with their announcement, gold is trading electronically only. So New York, you're seeing, gold up $60 as an example. When you go to, say, London, Kitco, you know what? I didn't even look, Jason. Kitco, probably gold's up
1150.
Up 1150. There you go. So 2040 there in London, because like I said, most of that move was after the Fed came out in the electronic trading. But yeah, 2040 on gold. Copper also having a strong day. A lot of people calling for a big run in copper as well. Being diversified here. This, the trap is being set, right? It's, hey, everybody's euphoric about, hey, the Fed thinks they're going to be cutting rates a bunch. The problem is, for that to happen, we're probably going to see the economy get really slow, right? That's kind of what the Fed is signaling. So, Wall Street, you got the euphoria of it, right? It's kind of a buy the rumor, but then sell the news, right? Got to sell the news. And I think it's going to be sell the news at least for part of 2024. Be diversified here, right? We keep talking about, hey, why refi up to 10.25%? Fixed rates of return, not correlated to Wall Street. They've actually made, the program was great. They actually made it better. Now, if you want to just say, you know what, I'm going to take a timeout for 2024. I'm going to do it for 1 year. They're going to give you 6.5%. They raised it a quarter point. Matter of fact, they raised all of their years except the fifth year. 2 years, 3 years, 4 years, raised it all a quarter of a point. Not only that, they already had, they don't have fees. They don't play games there. They just don't. If you do need your money back early, You know, and people know, like, if you've ever had annuities, you know how you get whacked with those things if you need the money. Not a why refi. You always got all of your principal back, all of it. Now, guess what? You're going to be able to keep that some of that interest as well. Check them out. InvestYRefi.com. That's the word invest, the letter Y, REFY.com. Or just call them at 888-YREFI-24. Jason, the big thing, and we said it yesterday, they decided the dot plot was going to be important. And there's 19 members total. So you've got like the 12 banks, right? The New York Fed, the Chicago Fed, San Francisco Fed, Dallas Fed, Richmond. You got those 12. You got Jay Powell. You got the vice chair. You got the regulator in New York. Total of 19 people put little dots on a chart to say this is where we think the rates are going to be going forward. And they'll go out, you know, a year, year and a half, and kind of just do a little graph. Now, the graph going into this meeting, which probably shouldn't be a surprise, was, hey, we're all right where we are right now. Right. Obviously, because that's where they were. They had two members say that they think rates will stay where they are. In other words, 2024, we won't have any rate cuts. No, I guess I should start with no members had a rate hike. None. So I guess that tells you, right, rate hikes are off the table. One member thought that they would cut rates once. Another, what was it, 5? It looks like 5 members said that they were going to cut twice. It's either 6. These dots are really small, so my eyesight's, you know, I'm old. It's not the best. 6, or I think it's 6, maybe 7, said 3 rate cuts. 4 of them said 4 rate cuts. And one guy, I don't know who it is. I want to know who this guy is. 4, 5, he said 6 rate cuts. And apparently they said, well, if you average it all out, that equals 3 rate cuts coming in 2024. And Jason, that was the big headline all after they came out. The Fed's going to cut 3 times in 2024. That's how they got here. I'll say this. This thing changes with the wind. It's never been that accurate. But the one thing that stood out to me, though, Jason, was pretty much all of them, with the exception of 2, said, hey, things are getting worse to the point we're going to have to cut at least once, somewhere between 1 and 6 times. 17 of the 19 said we got to cut 1 to 6 times. Nobody said a rate hike.
Correct, and it makes a lot of sense. I mean, if you really go to the motivation, which should be, you know, their job to keep the American economy rolling, right? Which that's not what they've ever been worried about. It's self-preservation and the interests of those that they represent. You know, the Federal Reserve, privately owned company. People need to understand this. This is not just 1 or 2 guys. This isn't the guys who made the Federal Reserve Bank. You know, this is a quite a wide range of very wealthy individuals, and. You know, I said on the last segment, there's a lot of debt rolling over. You know, the Fed, of course, the Feds, you know, they don't have to, they just print the money when they buy this stuff. So they don't really lose anything. However, paying back, you know, the debt, Joe, and the interest rates being high, they're going to want to cut these rates. They're going to want to cut these rates. Like you just said, the jobs number says raise them, right? Right? The inflation says raise them. You know, that we've got it at 5.5%. They can't get it below 3, the CPI year over year, and they want 2. So they essentially have to cut the CPI in half to get where they want to go. You know, and they're not getting it, Joe. They're not getting it. So, you know, hey, we got to protect our interests. You know, we don't want to pay we don't want to pay a high interest rate on all this debt that's rolling over. We're we're going to wait for the timing right when we really want to roll this stuff over, and then we're going to buy a whole bunch of it at the lower rate, and then I think the interest rates go right back up when the inflation blows everybody up, which I don't know when that'll happen next year. It could be the very end of next year, but we'll be here, Joe. We'll be watching. You know, it's funny that Jay Powell likes to well, in case some incredible thing happens. Isn't that code word for something incredible is going to happen one way or the other, right? That's what it sounds like he was saying. Just doesn't have the balls to say it out loud.
You got a CYA, right? You got a CYA.
Yeah.
Listen, I know we're all dumb this year, but I'm not saying that something the boomerang could come back. It is interesting, right? Because look, the 10-year note right now, it's below 4%. Matter of fact,
wow.
391.
It's really moving down.
391. You've seen a whole point plus come off a 10-year treasury in 30 days, like a month. That's not how these markets are supposed to work. And by the way, there's been no rate cut, right? There's just been, hey, things are slowing down. But look at today, jobless claims fell to 202,000, back near the lows, 202,000, right? Fell 19,000. Now, granted, that's seasonally adjusted, and I think the seasonal adjustments are a little off, but still, it's a low number. Let's not split hairs. It's a low number. Retail sales came in today. They were up, not huge, but they were up a couple tenths. And we know things have slowed down. Obviously, they understate inflation. We understand that, and the realities are it's up because prices are so expensive. But still, they were expecting a small little contraction. Jason, they didn't get that either. It's not like the data has been overwhelmingly negative. There have been. Now, Jay Powell did mention, the labor market continues to be the big source of strength, if you will. But it just does kind of set us all up here for and I think what they're getting at, wait till the money runs out. Then things really change. Until the reverse repo is out of money, things are going to look better than probably what they are, because he did talk about it. He absolutely talked about the reverse repo, still said, hey, we got money in the system still. Talked about, now he didn't talk about ending quantitative tightening, but he talked about it, and that's how it starts, right? Well, we're going to start talking about it now, right? We're going to talk about quantitative tightening. We're still doing it. But, then 6 weeks from now, well, we may end it, later this year, and then, 6 more weeks. Well, probably end it a little sooner, right? That's what's coming.
Did you see the score of that Raiders-Vikings game last weekend? 3-0. 3-0. That was the game, and the field goal was at the last 2 minutes of the game. Jay Powell kind of did the same thing in the question answer. He said, well, inflation isn't at our target, but wages are outpacing the inflation. So in a lot of ways, he's almost kind of gave himself the win there, because he said it was just ridiculous. The wages are outpacing the inflation. So to me, that's another code for we're going to be lowering rates, because hey, look, we kind of got our 2%. If you look at it in whatever warped way we want to change it, right, Joe?
Yeah, exactly. And it's something where, I guess it's all semantics, right? Yeah, I mean, I would take 3-0 right now. I just I don't know that the Fed can win here. But I think the thing that made perfectly clear to me was, hey, we're going to live with more inflation if that's the case, because he was specifically asked. Yeah. He was specifically asked, are you going to wait for inflation to get back down to 2% or less before you start cutting rates? And his answer was, he didn't say it, but his answer was no. His answer was, hey, as we approach 2%, we can start cutting rates. We can cut rates before inflation gets back to 2%, which just tells me that this is the sacrifice they're going to make. They don't have it. The money in the system's drying up. They need liquidity. They do. This is a debt money system. It's plain and simple. And I think what Jay Powell is saying is, hey, we've run this almost. We're not done. But we've drained the system about as best we can. It's getting ready to come to an end. And inflation's probably not going to be back to 2%. But then we're going to have to start, juicing it again. We're going to have to start printing money again.
We have some history, too, because with 9/11 and out-of-control government spending back in those days, that's when the Fed came out with 2%. They didn't say 2% mandated inflation in the 70s and the 80s, even though they had complete out-of-control inflation. But in the 90s, they didn't talk about they had to have 2%. There was no that came after 9/11, an emergency, right? And out-of-control spending, which wasn't going to get any better. Of course, the housing crash didn't make it any easier. Oh, take 2%. We should accept that. And Joe, we're either headed for one of two things: 4%. At some point, when we get past the bad inflation, 4% will be the new okay inflation, or they'll just reinvent how to calculate it, and that 4% will be then taken down to 2%, and they'll just claim victory a few years from now when everything's been destroyed pretty harshly.
800-951-0592. Jason and I, we're coming right back. Stay with us. We're back here, 800-951-0592. Joe and Jason, Patriot Radio News Hour on this Thursday. I got 100. I just got an email here. I've got 100 $5 Liberties. These are the old ones, 1866 to 1907. Just under a quarter ounce of gold here in a $5 Liberty. You're going to save some money today. $590. If you buy 10 or more, $585. And Jason, I think this just sets this up to where this is how I look at it. They're going to pump this thing because they're not quite ready. They need another year to get ready here. I think we're going to see a lot of dollar destruction in 2024 as they start the printing presses all over again before the weight of the debt finally caves it all in. Having fractional gold, I think, is now a necessity. We talk about fractionals. It's great. Silver's great. I think it's going to be huge. What a huge performance, not just today, but this year. Silver's been fantastic. Gold's up like, I don't even know, $220, $230 this year. Right? What's silver up? I don't know, $2, $3? Something like that, right?
Yeah.
Up big amounts. And when we're sitting here talking about what's coming, we already know. I've already got the handbooks written. Right? The central bank digital currencies, they're already coming. Remember, what was it last week? MIT, the Boston Fed. Hey, by the way, we need central bank digital currency, guys. We got to get ready. We got to get it all ready. We got the wholesale side going. We got to get ready for the retail side. Things are gonna be so expensive that stuff that I used to be like, well, yeah, you can use a Silver Eagle for that. That probably won't get it done, right? You're probably going to need 5 or 10 Silver Eagles for that, right? Hey, I'm going to trade eggs with the farmer. I mean, remember, what was it last year? A dozen eggs got to like $12. I mean, right? It was insane.
Yep.
Then come down, but everyone remembers. Right? These are the things that I think about now. A quarter ounce gold eagle. We are like, hey, you can pay your taxes with it. You could, maybe you get 2 or 3. You can get a generator with it. Stuff of this nature. You want to, I don't know, maybe you want an AR-15. Well, you may need 3 or 4. Of those. It's a great coin to have just in case you need it. Right? Hey. You're putting gold away. And you're not paying, I mean, it's not outrageous, right? You're paying under $2,400 for an ounce. And you got fractional material. It just makes good sense. 10% of our buyers are like, listen, I just want the cheapest thing you got. Cheapest price you got on an ounce of gold. That's all I want. I don't care. And we got 10% who I'm just prepping. I want junk silver, maybe a silver eagle, maybe a 10th ounce. Right? That may be it on gold, right? Maybe they'll do a 10th ounce of gold. But they're solely what I would call I'm stocking up on barter. The other 80%, hey, you don't want to pay more than you need to. Who does? But at the same point, you're like, you know what, those prepper guys, yeah, they're not that insane anymore, right? They're kind of probably, you know what, I want to do both. Well, this is for those guys that want to do both. This is right in your wheelhouse now. $590 on a $5 Liberty gold piece. Buy 10 or more, $585 at 800-951-0592. And Jason, I mean, all the gold calls coming out again. We hit that, that big interday high right now when we're looking at charts and things of that nature. We're sitting here right around $2,040 to the ounce. And again, we'll probably look for, that 2070, 2075 number, because that's kind of where gold was. And then remember, overnight it shot up. But if it takes that number out, right, then we're probably going to be talking about all-time closing record highs versus all-time intraday record highs.
Yeah, gold since late October has been trading in the 2,000 or upper 2,000 range since late October. So 1995, 2001, and then up to the record high we had recently of 2070. It's been doing that since late October. All right, it's staying in the 2,000 range, and it's hard to believe, but in October 5th, 2 weeks before it started trading in this range, it was at 1825. So it's moved. This one step up. You should have been buying back then when it was in the $1,900 range, but now it's in the 2,000 range, moving to the 2,100 range. And we still might have some ups and downs. I don't know. We don't know for sure. Joe and I are talking, hey, there's going to be some sideways action, but I'll tell you right now, don't wait, because when the Fed decides to lower the rates, it'll take off like a rocket ship. It'll probably happen on a Friday, by the way, and you won't get the chance to buy it in this range. It'll just be higher. So highly suggest if you want fractional gold, this is the time to get in, Joe. You guys are running out of time for this cheaper gold.
Well, I'll be honest. I got caught off guard. I was caught off guard yesterday. I was hedging my bets. Normally on Fed meetings, if you look at, they have, what is it, 8 Fed meetings a year. Gold falls 6 out of 8, right? Because it's normally a meeting about strong dollar, right? That's what they want to portray. Lately, they've been very wishy-washy. And I thought that would continue. I was wrong. And look at, $60, just like that. We're going to be seeing, this is the nature of it, right? The higher it goes, obviously now, a $60 move in gold. Gosh, when I started, that would have been unthinkable. $300 gold and it goes up $60 in a day. That wouldn't have happened back then. God, my God, gold's up $10, right? You're getting all excited on a $10 move, right? Now, gold's up 60, and we're kind of like, yeah, that's kind of normal, right? Now, I hate to say it, but right, we've been seeing a lot. Look at when gold hit a new all-time record close. We had several days. Gold was up $30, $40, $50. Of course, and then overnight, it jumped $60, $70. Those are going to be considered smaller moves as we move forward. Take advantage here. 800-951-0592. 1-800-951-0592. Joe and Jason, Patriot Radio News Hour on this Thursday. Again, the special today, $5 gold liberties, 1 through 9, $5.90, 10 or more, $585, as it appears that the Federal Reserve essentially is done raising rates. That is no longer the base scenario. The rate cuts now, the vast majority, 17 of the 19 members, expect 1 to 6 rate cuts in 2024. 2 people thought they would stay the same. I guess the average 3 rate cuts coming in 2024. So let's think about what's coming. Okay. 3 rate cuts. Let's use that. Could be more, could be less, but that's okay. Doesn't appear like there's any more rate hikes. That's off the table. Okay, so that means gold and silver are going higher. Right? Gold, the dollar will go lower. They're trying to, get yields to come back down. 3 rate cuts, maybe a little less, maybe a little more. All of those drive gold and silver. On top of it, Jay Powell mentioned a couple of different things. On top of these, if that wasn't enough, the ending of money in the reverse repo facility. A lot of that money, obviously banks, but a lot of that money markets, probably regretting not buying more treasuries at higher yields, but money markets, now that rates are going to go lower, I think they're diving into this thing, right? Hey, let's buy as many treasuries as we can, because remember, how do you make money on bonds? You make money on bonds when yields go down. This last month, and I guarantee you, I don't know, but it was probably the best month for bonds since COVID. Maybe longer. Heck, it may have been the best month for bonds since the financial crisis. Right? When yields went from 5+ to 0. I mean, it's unprecedented kind of what we're seeing here. But when that facility runs out, Jay Powell said, hey, yeah, that's okay. It's kind of going to be a problem. But banks still have some excess capital too. We got some excess capital there. Obviously, that capital can't go to 0, right? That's the problem, right? How much is enough? I don't know. Right now, they're between 3 and 3.5 trillion. Sounds like a lot, but not really. Not when you think about all the debt that's out there. How much is enough there? I don't know. Again, I venture to say they're going to be buying bonds because the Fed has told them you can make money in bonds right now. You better hurry up. Jeff Gundlach came out and said, hey, I think 10-year notes going to be 3%. I just said 3.9. So let's call it 4 to 3. That's a big move. That's 25%. That's a big move. I think a lot of that excess liquidity, Jason, goes away real fast here. And then, of course, Jay Powell also then talked about, well, we can still run off the balance sheet, but acknowledged, hey, when the money runs out, we're going to have to stop quantitative tightening and obviously stop it before that. He hasn't given a time on that, but I think we're going to get one of those soon as well.
Well, and yesterday's, the media around the meeting and what was being spoken, I think is a really good call to, hey, FOMO, right? Fear of missing out. We're not going up anymore. We're going to be going down. Hey, foreign investor, do you want to borrow and get that bigger rate, you better jump in. I mean, so I think that it was definitely a big pitch to get their auctions revved up a little bit, Joe, because they're selling hardly nothing, right? So, if they say nothing but down, sideways or down, then anybody that's thinking that Treasuries are a good place to get into, this is the highest rate you're going to get for the foreseeable future, right, Joe? So I think that's another one of their goals, because the government still wants to spend, right? Right, the government still wants to spend, so someone's got to borrow that. Someone's got to loan that money to them, right?
Yeah, that's the kind of the biggest thing that we're talking about in all of this is the fact of the matter is the Fed is signaling that, hey, we're going to run out of money. And once we've run out of money, right, we've got to do something to get more money back into the system. And the answer pretty simply is, let's keep lowering rates, right? Let's lower rates. I want to know the one guy that said 6. That's the guy I want to talk to, right? That's the guy I want to talk to. Because that guy's saying, hey, it's going to get ugly.
Well, I guess what it really comes down to is, 3 rate cuts can be very much worse than the 6. If it's 6 quarter points, well, what if this big emergency that Powell alluded to makes it 3 1-point cuts, right, Joe? Suddenly,
yeah,
3
and
rate
I guess
cuts.
I needed to preface that. You're right. They all of those cuts were a quarter point variety. So when I say 3 cuts, where they put their dot, that signified 75 basis points lower than today. So to Jason's point, that doesn't mean 3 meetings, right? They can do it in 1 meeting, right? They could,
right.
So when I'm saying 3 rate cuts, what I guess I really was saying is 75 basis points lower than what it is today. And if you do the quarter point thing, that would be 3 quarter points. But to Jason's point, doesn't have to go that way. 800-951-0592. $800-951-0592. Final segment here. Patriot Radio News Hour. Joe and Jason. $5 Liberty Gold pieces 1 through 9. $5.90, 10 or more. $5.85 at 800-951-0592. Gold 2040. Silver almost 24.25. Almost up $1.60 now on the move in silver. And like I said, we got caught off guard because I didn't expect this until the next meeting. I didn't expect this until the meeting at the end of January, because at that point you had a lot more runoff in the repo, and of course you have got to remember continuing resolutions, right? That the government spending. Matter of fact, right now they're going to be, the House is supposed to be voting on a $881 billion Defense Act bill. Now they're not. They're spending money, believe me, and they're going to spend a lot more of it. Plus the fact that the Treasury, right? They've already said, hey, first quarter next year we gotta raise another. We don't know the exact amount, but somewhere around 100. I want to say, let's call it 115 billion, 120 billion. So I expected that then. We got it early, Jason, and I think this is just, you want to be in now, because I think a lot of these events over the next 6 to 12 weeks, we're going to have 2 or 3 more of these events happening that I think drive gold, drive silver, talking about continuing resolutions, Treasury funding, the talk, I think, from the Fed now of when the first rate cut may be, in addition to, hey, we're going to need to start talking about ending quantitative tightening. I think we can see all of those in the next 12 to 16 weeks.
I think that's likely. Yeah, for sure. The reverse repo, as you mentioned many times this hour, that's that fuse that was lit some time ago, and as it slowly gets down to that ending position, yeah, the rate cuts are probably coming, Joe. And should they cut rates? Not with inflation. They should they should have raised them They should have raised them yesterday, Joe. They should have raised them, But there's too many fat cat friends they have on Wall Street and in very influential places in the world, and they got to keep those guys floating as high as they can. So I think that's their goal is to float these markets as much as they can next year. And if the small guy has to pay, $100 for a steak, so be it. The rich guy can afford it, Joe. That's what we're heading for.
Yeah, that's exactly what I see as well. This is going to be very interesting how this all plays out. And again, I didn't think it was possible to be able to get below 2% or back to 2%. And Jay Powell just confirmed it yesterday, saying, "Hey, we're not going to wait for that. We're not waiting for that. We're going to have to start cutting when the money runs out." Because he didn't say that, but that's what he said. We're going to have to start cutting when the money runs out, right? And the money runs out in the next, say 12 to 16 weeks. The money runs out, so it just makes sense. It's a great opportunity here. 800-951-0592. Joe and Jason, we're coming right back with the Half Empty Cup.